Good morning, everyone. Thank you so much for coming to join us this Wednesday, May 27th, 2020. My name is Tyler Wood, and I'm the Managing Director of Global Business Development for the CMT Association. And with me this morning is the illustrious Stanley CMT, Director of our CMT program. So thanks so much for taking a minute out of your morning or your evening, wherever you might be around the world. We wanted to get this session together pre-U.S. market open to talk a little bit about the CMT program. I know we've got a few folks on the line who are already candidates in the program. They've already enrolled and they're looking forward to their December exams. But we've got a lot of folks who've joined us who are just looking for additional tools, things that they can add to their investment discipline to help manage the volatility that we've seen so far this year. So we're going to take about a half an hour. We're going to talk through a little bit about the association, a little bit about the CMT program, and Stan's going to talk to you about why you should even care about technical analysis. What are these tools that could help investors improve their performance on a risk-adjusted basis? What is it that you're going to learn in the CMT program that's so applicable to a career in the financial services industry? And we'll talk a little bit about the career opportunities that open up for those who get the CMT designation after their name. So let's dig right in. Respect everybody's time this morning. I'm going to start and just tell you a little bit about the association. For those of you who don't know, the CMT Association is now almost 50 years old. Started with a small group of sell-side research analysts in the equity space in New York City. But you fast forward to today, and that small group of very dedicated professionals has expanded around the world. We now have members in over 137 countries. There are about 35,000 folks who participate regularly in our educational programming. We do a lot as a member services organization in terms of publishing, hosting broadcasts like this with experts from the field. So there's a ton of educational content as well as the professional network. And that's really meaningful to us and to the members of the organization that you can connect with CMTs around the world. So we've got roughly 10,000 candidates who are currently enrolled in the program and sitting for exams over the last few years. As I mentioned, the CMT program is one of the main and most important things that we do, but as a nonprofit credentialing body, we do a ton of other continuing education. So if you're later stage in your career, maybe exams aren't for you, or you're not looking for the credential, I invite you to join the CMT Association just as an affiliate member and take advantage of tons of learning resources. We do have weekly webcasts with industry experts. We host events all around the world. Very proud to announce we launched our Mumbai, India office about a year and a half ago and had a nice housewarming party in November. Had a huge conference with about 300 folks. We also host an annual symposium in New York City every April. Unfortunately, this year, for the first time in 47 years, we did need to postpone that in light of the public health crisis. But we've moved a lot of our content online in the digital fashion so we can all network together alone at home. So let's talk a little bit about the CMT program itself. It's a 3-level exam, and we offer all 3 levels of the program twice a year, once in June and once again in December. So for those of you who were registered for the June exams, you also saw that we needed to postpone those exam dates. We work with Prometric test centers all over the world, but unfortunately, just due to the coronavirus, there was not a chance to keep enough of those test centers opened. So we've actually moved the exam date. We'll be testing in December, the 1st through the 15th of December 2020. And I'm proud to announce that working with those partners at Prometric and the diligence of the CMT program staff, we have the capability now to test in a remote proctored environment. So what that means is that for years, candidates have gone to a live test center, very heightened exam security. It's kind of like going through the airport. You turn out your pockets, make sure that you're not bringing anything with you to the test center. And thanks to the advances in technology, they're now able to offer that same secure testing environment to preserve the integrity of the exams from a home or an office. You can take this anywhere in the world. And so December 1st through the 15th, we'll be offering those CMT exams again. But why would anybody sit for a very rigorous exam, very high stakes test, Well, the value of the CMT designation is multiple fold, right? There are a lot of folks who go through the program for a guided study of technical analysis to improve their investment performance, to gather those tools and put some more arrows in their quiver, so to speak, to deal with market volatility, to capture alpha and find opportunities while managing risk on behalf of their firm or clients. But we did some interesting survey work a few years ago, and we reached out to CMT charter holders that had recently gained their designation. They were recently awarded the CMT, and we found out what happened for them in terms of their career path. And you'll see on that graph there that statistically, a lot of folks are getting promotions, new positions. They may have changed firms or taken on a bigger role. So it's over 40% that were promoted, close to 50% who were working in new positions within a year of obtaining their CMT. But there's an interesting stat there around more responsibility. And what that means is that folks who were managing money on behalf of their firm or clients, they had an increase in AUM. And that tells us that the CMT designation instills a sense of trust. There is a knowledge that you have mastered the entire candidate body of knowledge from the CMT program. You have impeccable risk management skills, and you have a repeatable, defined process for investing or analysis or trading. And that really helps clients and firms have that trust in you to allocate more resources to your fund. And so I want to reach out to those who are managing client money right now or thinking about a career in that space, that the CMT charter really does have a meaningful impact worldwide. You'll note that CMT charter holders all over the world hold very different positions. It's not a single sort of path that CMT charter holders take. We'll see a lot of research analysts, both on the technical and fundamental side. Yes, I said fundamental analysts who hold their CMT, because the combination of the tools is very, very powerful. And you can understand the fundamentals of a company, but you also need to understand the market moves, the supply and demand relationships, and the market sentiment, the mood of investors. And Stan's going to talk about some of those tools that help measure that. We have investment strategists all over the industry, all over the world. About 20% of our members are portfolio managers. They work in the brokerage space or as advisors as well. So it really does open a lot of doors for a diverse set of career paths. So as I mentioned, it's a 3-level program. The CMT Association produces the official CMT curriculum. And for those of you who may have sat for an exam many, many years ago, you'll remember the stack of books, and you read several chapters from each, and those were foundational texts in the technical analysis world. But we also wanted to make sure that study was efficient and as succinct as possible. So the work of Stan and others on the CTC, our volunteer board that helps steer the curriculum and the test, they actually consolidated all of that into a single textbook at each level. So you know exactly what you need to study to prepare for the exam. We publish those textbooks through Wiley, and you can find them at efficientlearning.com/CMT. For those of you who are on the call this morning, we also wanted to extend an offer from our colleagues at Wiley. You can take 30% off your textbooks just by entering that code, CMTTW30. And that'll get you access to the official curriculum, and they have many other resources there as well. The other interesting partnership that the CMT Association created several years ago was with a gentleman named Matthew Ridow and his company Optima. And what we realized is that technical analysis is really a practical study of the markets, and that you can read a lot about the tools, the mathematics, the theory, the concepts from a book, but you really understand technicals by rolling up your sleeves, getting your hands on some charts, and understanding how to use them. We've also added a lot of quantitative methodologies to the program in the last 5 years as a result of our practice analysis, talking to folks in the industry about what tools, skills, knowledge, and abilities they wanted their next hire to hold. So the CMT curriculum includes a lot of Monte Carlo simulations, forward and back testing, understanding how you would evaluate a systematic strategy, and the tools in Optima are available to all CMT candidates for free while you're in the program. It's a very generous offer from Optima to make sure that you have a great charting package to test these tools out on your own and really understand how you apply them in the investment discipline. We've also had some great partnership work with the CFA Institute. And one of the things we did in 2016 was to adopt the standards of practice and the code of ethics. So financial ethics are financial ethics, and when looking at our code compared to the CFA Institute code, they were almost identical. But what CFA Institute had created was a number of really helpful case studies for understanding the nuances around ethics. So candidates in the CMT program will actually be able to use the CFA's Code of Standards and Handbook to study for the exam. There's hundreds of pages of great case studies to understand how those ethics are applied. That partnership with CFA Institute has grown over the years, and in fact we now are part of the Stackable Credentials Initiative. So for those of you who hold the CFA charter on this call, or anybody else listening in the future, if you're considering an additional set of tools that will help you in your research, trading, your portfolio management, the CMT program is really for you, and you're able to start at level 2 of the CMT program. So that exemption on the level 1 exam doesn't exempt you from all of the learning that's required at level 1, but you do not need to sit for the exam. And that came out of a long period of curriculum mapping. We understood that a number of the same topics were covered throughout levels 1, 2, and 3 of the CFA program. And through that partnership, CFA charter holders are able to start at level 2 of the CMT program. So that, my friends, should be a quick introduction for you about what the CMT program entails in terms of sort of the plumbing of the exams and the structure. But we're going to dig in deeply now and talk about the tools that you're going to learn throughout the program. And for that, I'd like to bring my good friend and colleague, Stanley Dash, onto the line to make sure that you all can hear him. Stan, can you say hello real quick?
Yes. Hi, everyone. Thank you, Tyler.
Excellent. Stan is a longtime Grateful Dead fan and the director of the CMT program. And I highly recommend for any of you who have a chance to get to New York to the symposium to come and seek Stan out. You will learn a lot even in a short conversation with this gentleman. So Stan, at this point, I'll hand the floor over to you.
Great. Excellent, Tyler. Let me make sure I'm clicking the right buttons. And that looks like my screen should be coming through now. So thank you for the handoff, Tyler, and thank you for the introduction. There's some information about me up on that screen. Tyler summarized it pretty nicely, and I'll leave it up there just for a moment so you can see it. The takeaway that I would hope you get from that is not just my age, but the takeaway that I would hope you would get from that is that I've been in many sides of the financial services industry, of markets and market analysis and technical analysis in particular. I've also been involved with the association for many, many years, even before I joined the staff. I like to think that that perspective is useful. It means that I get to work closely with the membership, people I've known and worked with for many years, but now I'm working with them from the perspective of a staff member looking to reinforce the program, make sure the program stays current, and that the value of the CMT charter is recognized for all of us, because I'm a charter holder as well. One of the things I'd like to mention while this slide is up is why did I get my charter in 2014, which is relatively recent, if I've been had decades of experience in financial markets. I was a member of a futures exchange. I've worked with different brokerage firms, written a lot of research, done a lot of programming work. When programming came along, I had to catch up because I predate the personal computer in these markets. The reason I did it in my case was really a personal challenge. I had been a member of the association for a while, and I had taught classes with other CMT charter holders, including one of the founders. We had done some work together educating. And I was also managing a staff of research analysts, a small group of four research analysts at one point, who were all CMT charter holders, and I was not. So I decided that after being a member for a while, managing CMT charter holders, it was time for me to take the challenge. excuse me, it was time for me to reinforce my knowledge, to fill in some things I'd never worked with, even though I had a depth of knowledge in some areas of technical analysis. Others were sketchy. And this gave me a more rounded view on technical analysis on things I'd never worked with, some of which I've incorporated, others perhaps not. And it also gave me the credential. It gave me the legitimacy in managing a staff as a calling card. I think it was a tremendous benefit in that way. So I was one of those who came to technical analysis early in my career and even to the association early on, but came to the charter much, much later. And it was well worth the challenge. It was a lot of work. It was, at certain points in your career, you question yourself on taking certain new challenges, such as studying and exams, and you fall into ruts. But it was really a wake-up call, and it brought me. It opened up new horizons even after many years in the business. Think about that. I don't know who's out there. I don't know what position many of you are in, but some of you may relate to that anecdote, and I would encourage you to look at the program, even if you think you are already beyond it. You may not be for a number of reasons, both the knowledge and the credential. Let's move on to some other things. As I said, I don't know who's out there. I don't know if some of you out there are looking strictly at technical analysis without knowing much about it, or you're very steeped in it. If you know technical analysis well, please bear with me for a slide or two. I'm not going to spend a lot of time on this, but I do want to make sure we all have the same vocabulary. That's the educator in me, is if we don't have the same vocabulary, we are not communicating. And so very important to have the same definitions and an understanding of what our topic is and what our discipline is about. So we can summarize technical analysis as the study of price action and market statistics such as volume, many other types of statistics that are specifically related to the action in the marketplace. And we use them to infer trends in price and to manage risk. If that is as succinct an elevator definition of technical analysis as I think I can get to. We're going to analyze the things that go on in the marketplace and the statistics it throws off. I wrote, for example, volume, but it could also be open interest as it relates to futures. It's going to be options calculations and volatilities coming from the options market. It can be certain sentiment measures that come from the marketplace, put-call ratios, which relate to the options market. Those are all statistics that we get. It's data that we get from the market action itself. We benefit our economy, and we benefit from having free markets and a good flow of information. And we use that information to decide. There are really three questions. What's the overall price direction? What's the trend? How can I participate in it? I have to make a management judgment on how I can participate in that trend. And how do I know when I'm wrong? How do I manage the risk? And if I can identify the trends, figure out a way to participate and know when I'm wrong and live to trade another day, then technical analysis has served me. I put a few other definitions of technical analysis on here because a few reasons I put them up. Some of them are quotes from our texts, and I do want to pay respect to some of the people who've done some great work in technical analysis and who've contributed to our text. And also, these additional definitions maybe provide a different way for you to think about technical analysis. If one definition doesn't resonate for you, another one might. Perry Kaufman, whose work is seminal to every technician and who's still an active writer and technician, systematic evaluation of price volume for the purpose of price forecasting. Edwards and McGee, Chuck Bassetti is the most recent editor of the work of Edwards and McGee. Edwards and McGee are known for their catalog, the catechism of technical analysis, the study of the action of the market itself. Some people also just have defined it as supply and demand for shares or contracts, and I want to expand on that in just a minute. Hold that hold that thought for a moment. In fact, just hang on to that for a moment. I'll come back to it. We mentioned the study of price, volume, and time. A technician often asks, what is happening in the marketplace? What's the price direction? How can I participate? When do I know I'm wrong? And focuses less on why is it happening. Now, as technicians, we don't operate in a vacuum. And Tyler alluded to the fact that there are fundamental analysts who use fundamentals and technicals together as well they should. Fundamentalists tend to focus a little more on the why, obviously with coming up for an investment plan or a trading plan. But technicians focus more on the what is happening. Can I identify the trend? Can I get in on it regardless of why it's happening? And of course, can I identify my risk levels? Do I know when I'm wrong? But the technician focuses more on the what than the why. That's often why it's a very good complement to fundamental analysts as well. Many CFA charter holders in particular and other fundamental analysts will use technical analysis because it fills in, I know why something is happening. I can understand the dynamics, the macroeconomics, the government policy, but I need to know what's happening in the marketplace and how to manage myself through what I actually observe in the marketplace. Now, what I put up, I want to bring you back a couple of bullets. Maybe I should have put them in a different order to that middle one, the one that says supply and demand for shares or contracts. The reason I want to do that is we came across this slide that Tyler had, and I'm not sure, one of our colleagues created it. I'm not even sure who it was. Doesn't matter right now. But I did like the slide. Tyler, you taking credit for that one?
Originally, this came from Ralph Akampora's slide deck at New York Institute of Finance. Although he used IBM, which was sort of the mega cap stock of the day, I adapted this and added some animations, which I see you have clearly taken out, Stan.
I took out the animations because we're not going to spend that much time on the slide. But I gave you a compliment. It's well done, and if it's Ralph's work, it's always got a good foundation anyway. The point of the slide here and the point of that bullet before when I said supply and demand for the shares or contracts, let's say shares of a company, is we tend to focus on whether a company is a good company or not. It's important. Are they making good products? Is there demand for their products? What is their financial condition? And are they able to pay dividends? Who is encroaching on their marketplace? Are there competitive threats, or are they a competitor who is now attempting to dominate a segment? How good is the management? Those are all important information about the value of a company, and they're just not what a technician looks at. Because there are times when all of those are disconnected from the supply and demand for the stock itself. When those are disconnected from what is going on with the shares. That's what we talked about before about looking at the markets and market action. I may see that a company, we use obviously Apple as the example here, we may see that a company is productive, is well managed, is in good capital shape, is paying dividends, is producing new product, has everything going for it, and yet the price action makes us scratch our heads. Well, why isn't it just twice the price that it is? Well, it may get to twice the price that it is. It may in fact double, but what's the path it will take? All of that is what technical analysis is about. What's actually happening? Why is it taking the path it's going to take? Perhaps it's psychology. There are behavioral finance aspects of it. There are sentiment aspects to it. Maybe it's the supply and demand aspects of the stock. Maybe certain of the stock is coming to the market and being traded out for certain reasons, and there's supply and demand for the actual stock. So this is, if you had to break this slide up, the top half would be fundamental analysis and the bottom half would be technical analysis. They do go together. It's important to put them in their right place, but if you can mesh them, it can be very, very useful. The bottom half is what we focus on as technicians. So many people will get stuck on the charting aspect of technical analysis. Let's put it right out there. They will get stuck on the fact that people draw lines on charts, that people have these arcane analyses with different indicators that we'll mention. Well, just remember that technical analysis is based on organizing the data in a time series, being able to understand, to glean important information out of that time series, and the organizational structure traditionally has always been graphic. Bar charts, line charts, candlestick charts, point and figure charts, and many, many other types. All of these and everything I'm talking about is in our curriculum. It's all covered in the CMT curriculum, the charting, but not just the charting, the more advanced concepts we're going to get to, and let me tie that together. When we talk about things like I didn't call it charting. I just put organizing data next to the bullet because that's the way to look at the chart. Look at the chart as an organization of a data set. It's data sampling. And then I'm going to do analysis, statistical analysis, time series analysis on that data. And how I organize the data as a human being, I absorb that information visually. That's the way we absorb things. I used to say if my dog could come to the screen and smell a bull market, that would be great because dogs use their noses. But we use our eyes. We absorb data visually. And that's why this is important. It's not because we're reading charts, which we do, and don't decry that. But it's not just because we're doing that. It's because we're organizing data sets in various ways. Those different types of organization are different ways of visualizing and organizing the time series. We look for patterns in those series. Some people say the patterns are kind of funny. What's that head and shoulders? That's the one that everybody always picks on. Well, it's a display of the psychology of the market, and we do bring behavioral finance into our study. As an old timer, I like to say that we were doing technical analysis before behavioral finance was recognized as a category and before Nobel Prizes were awarded, because we always knew of concept of a market that ran too far too fast. Well, behavioral finance explains that in many of the biases, the emotional biases, the cognitive biases. It explains things about support and resistance as people return to previous levels. It explains things about overbought and oversold in terms of framing, anchoring. So behavioral finance is in our material, and it explains a lot of these price patterns because bottom line, it is still people who are driving the market. It is still our fear and greed that drives the market. Dow theory, of course, is an essential part of technical analysis, and it's in our material. And we owe it to Dow and his successors who organized a lot of what his thinking was after he passed away, the ideas of putting together a formal way of analyzing a trend and seeing how a trend. We've moved, I'm going to say beyond Dow theory, but it has not supplanted Dow theory in terms of understanding the phases of a trend and the importance of trend relationships. And of course, we use indicators derived from price and volume. We'll see a few of those later on. We can get distracted by the smoke and mirrors. The whole idea of an indicator, I'm going to mention it again in a few minutes. The whole idea of an indicator is, does it help me see the price action better? Does it help me peel away some of the volatility, the excess volatility, the noise, so I can see the essential price movement? And if you look at indicators that way, you'll find that some of them may not help you at all. They may help others. They may not help you. They may not be that valuable. They may repeat what others do. And you may find that, you know what, instead of looking at the raw data, when I look at the indicator, which smooths the data or gives me a less noisy view of the data, I can see the market better. Now, I have two quick definitions here on something that's in our text, but I also know that depending on your experience, there may be confusion on how these relate to technical analysis. So one term I wanted to mention is quantitative analysis. The word quantitative has more syllables in it than technical, so it's got to be a more important word. That's a joke. I pulled this definition about using complex mathematical and statistical modeling. It doesn't have to be that complex, but using complex mathematical and statistical modeling, measurement, and research, assigning a numeric value to variables to replicate reality mathematically. I gave a talk a number of years ago as we were entering the computerized age about quantitative analysis. And I theorized, I tried to joke, I hope you find it humorous, that we gave technicians computers and suddenly they were quantitative analysts, and that's where it was born. And it really does quantitative analysis I see as an offshoot of technical analysis, or an increase, or a companion. It's another part of it because it's looking at the data from the marketplace, modeling it, using indicators, measuring it, organizing data, researching it. We can go further. There's quantitative work on things that we might say is not just technical data, but also fundamental data. And I'm not arguing that. But if you want to keep in perspective, well, I don't want to learn technical analysis, but I want to learn be a quant, they're related. Technical analysis is a critical foundation for quantitative analysis. And depending on the direction of quantitative work you do, there may be other disciplines that come in and join with technical. But technical is the foundation for understanding there's a marketplace time series, there's data coming at me. How do I find the signal inside the noise, and how do I organize the data? We do talk about quantitative methods in our material, in our curriculum, and they are part of the CMT program. The last one the definition I wanted to make is algorithmic trading, because that confuses people as well. We probably all know the definition of an algorithm. It's a formula, a step-by-step procedure, a formula, a series of logical operations, whether we program it in an actual computer language, or whether it's just the recipe we use for baking bread. We all understand what an algorithm is. So algorithmic trading is a part of the world. It also goes hand in hand with technical analysis. And yes, it can be used with other forms of analysis as well. I'm trying to get that these buzzwords of quantitative analysis, these buzzwords of algorithmic trading are supported by technical analysis without decrying other tools and other methodologies. They're supported by it. There are different ways to use the technical work that's underneath it. In some of my longer discussions, I break algorithmic into two different areas in order to understand it. One is algorithmic order placement and management. In other words, a firm might be managing money, and they need to get a long position of 500,000 shares, and they're going to have an algorithmic method for accumulating that position based on the VWAP, based on other calculations, based on time slices. That's algorithmic order placement and order management. We're a little more, there's some of that in our program, but our program is a little more focused on algorithmic decision making, which is essentially trading systems. Is having some rule-based trading, which is some logical approach using technical analysis that says these circumstances in the marketplace, based on technical work, have a propensity to yield higher prices or lower prices, or are a signal to be out of the market completely. That's basically a trading system. We have some wonderful work by a guy named David Aronson that's in the book, also some of Perry Kaufman's work that's in our texts, that really talks about the logic of putting together trading systems, that we don't give you complete packages, but their work points you to building the logic that's needed, the things to keep in mind in putting these together built on a technical foundation. So I wanted to talk about quantitative analysis and algorithmic trading because they're not in conflict with technical analysis. They are in addition to it. They may go in other directions as well, but they are a complement and extension. I spent many years working on strategy, on system development and systems testing at a firm I was working with a number of years ago. So I had to take my knowledge of doing charts by hand and learn how to do programming and learn how to do back testing and learn how to do the statistical testing required in back testing. But it was still all built on a statistical foundation. I assure you we didn't do regression analysis by pencil and paper years ago. And yet it was built on my understanding of markets and market data.
So Stan, I mean, you talked about a number of really massive shifts, regime change in the industry. So moving from open outcry exchanges to an algorithmically delivered order execution. You also mentioned charting by hand, right? Pencil on a graph to plot the daily close or period close. And now we all carry, 5,000 charts around in our phone, right? Have the inputs, has the information or the factors by which you make decisions changed at all, whether you're charting by hand or pulling them up on a computer?
Some of them have. Some of them have. The essentials no, and some of them have. Clearly, the ability to slice time has changed. I can remember when I was a member of the COMEX. I was on the gold floor for a while, trading my own capital, and I used to do point and figure charts by hand and other charts by hand. And then if I missed some data, I would go into the chart room and I would fill it in on my chart. I remember the first graphics generator that made a chart when 5 of us stood around it and waited for the chart to come up. And it was a daily bar chart.
Yep.
So I couldn't look at 3-minute charts. I couldn't look at 500 tick charts. I couldn't look at 144 tick charts, which some people like to look at. I could not slice the data in that way. I couldn't go back to historical data in the same way. So that has certainly changed. I did back testing by hand, and it was an incredibly tedious process, and it could only be done on daily data.
Yeah.
Some of the inputs, so some of the methods have certainly changed. Some of the inputs you talked about, probably the area in which inputs have changed the most may be from the options market. And that's a combination of both the ability to do the analysis and computerize it, as well as the fact that there's a vibrant options market. I can remember when the CBOE started in 1972, I think it was. We didn't, the whole concept of doing doing options modeling, deriving volatility analyses, the Greeks, these were all non-existent or just papers that Black and Scholes were writing back in the 70s. So we couldn't incorporate that way. There was certainly no VIX. So I think also a lot of methodologies have changed by virtue of new instruments. I remember options on futures started in the early 80s, I think it was. So we had the futures market, but now we had options on futures added to that. So we had an additional arbitrage and calculation. Stock index futures created a different perspective on the stock market. So at the deepest level, I'm going on a little bit long here, Tyler, but at the deepest level, it's people still under it.
Yeah.
It's still the fact that the computer doesn't really care if it makes money or not. I care if I make money.
Right.
And I fear for losing money. That's greed, fear and greed, and that's what drives all of us, behavioral aspects. We now have tools to displace that a little differently. And we have additional statistics for understanding it and additional financial engineering. And of course, those changes are reflected in the world and globalization in markets and the flows of capital.
Thank you.
Did I go on too long for you?
No, that was great. I've had enough coffee, and I bet our audience has to.
Okay. I know I'm going on a bit. Stay with me a little longer, guys. There are a few other things I want to talk about and show you a couple of charts, because it wouldn't be technical analysis without some charts. There are 3 aspects of technical analysis I want to talk about. I want to tie together, these are all in our curriculum. They're all traditional technical analysis, but I want to show you the modern applications of them. And I think one of the things we have tried to do and continue to do in our curriculum is what is important from the past. We'd never throw out history. We may debunk mythologies that have been carried down, but we never want to throw out history. But we want to say, what is critical from that history? What can I learn from it? And how do I apply it in the modern world, which is a perfect setup from Tyler's question. So 3 things I want to talk about: relative strength, breadth, and divergence. And it lets me talk about things that are in our curriculum, things that are commonly used traditionally and commonly used today in applications. And it'll give you a sense of the modern application of technical analysis. So let's talk about this idea of relative strength. It's exactly what it sounds like. It's that I'm comparing the strength of 2 different markets or 2 different securities. I measure the relationship between the 2 of them. The simplest way to do it is what Pring writes here. I just grabbed this definition from him because I thought it was succinct. One security divided by another, just the ratio. If I use a ratio, it adjusts for as price levels change, and it gives me a view on the relative strength between the 2 of them. The fact that one stock may be 7 times the price of another stock doesn't tell me anything, but the change in that ratio tells me something. If it's 7 last week, but it's 7.5 this week, it tells me that the numerator is getting stronger relative to the denominator. Now, this is often done with 2 securities, as I just mentioned in that example, or it could be done with a stock against an index. It could be done with any 2 markets. Presumably, they have some relationship, or else you're comparing things, but they may not have any real trading or economic relationship. So here's an example. Here's a chart of GLD. It's the gold ETF, GLD. And SPY, we're using SPY for the S&P. It's a perfectly valid proxy, and it makes the comparison easy. So, and this is up to date. This is through, probably did these last night or during the day yesterday. So these are within the last day or so of trading. And you can see what am I looking for? Well, I'm looking to see, is gold leading this? Is gold stronger than stocks, than the S&P, GLD versus SPY? So I'm looking at the two charts. Now you can see periods. This, of course, is where the market peaked right before the washout that we had in February. We all know where that is. And this is the comeback we've been experiencing recently. Now, gold also was rising during that period. And gold peaked and had a real drop-off, and then continued its rally, made new highs. Well, I can see periods where I think one is stronger than the other. Can I analyze that mathematically? And the way we do that is that simple relative strength ratio. This is exactly as simple as I just described it. It's the GLD divided by SPY. Closing prices, it's daily closing prices. So you can see, yes, when the S&P, when the stock market first started that washout in February, boy, gold really took off relative to S&P. It's not just strength, it's relative strength. We saw how gold was. But look what's happened since. Now we see with this comeback, when the market bottomed, and with the comeback we've had in equity prices, gold really has lagged. Now, it's not continuing to weaken, but it certainly has not had the strength that it had on the way up. What's more interesting analytically is before the stock market made its peak, look what started to happen. Gold started to show relative strength. There were a number of nudges of relative strength before that, after a very long period of really, I'll call it equality. You can look in more detail. It wasn't quite. But we started to see, wow, gold is really starting to poke itself up. This is the beginning of 2020. And it's right. It's in this period in here. So you can see there was some rally in gold, some weakness in S&P. But there were some warning signs in here that the relative strength was about to shift in favor of gold. And it certainly was, and it certainly has not been. And I've been reading some things about the gold rally, and I've been scratching my head about where is it? Okay. Relative strength, that was comparing gold to S&P. I just want to show you this quickly. Within the last few years, someone has developed a new way of looking at relative strength, a new way of displaying it. One of the challenges in looking at relative strength is being able to look at the history. As I said, these numbers don't really mean anything. It's how the numbers are changing. Is it getting stronger or weaker, one vis-a-vis the other? And how can I compare multiple symbols? How can I compare multiple tickers, multiple markets to each other? And then it's not just whether one is stronger or weaker. It may be stronger today, but is the relative strength itself showing momentum? And that's what a relative rotation graph shows. I won't belabor this. Those of you who have access to Bloomberg terminals can use these on Bloomberg terminals. This is taken from Optuma. Our friend Matthew Verdal, who's also a charter holder, has this on his platform. That's the platform you have access to as a candidate in our program. And I threw up the S&P sector spiders so you can see. What's the idea? The idea is saying which ones, not only which ones are leading, but which ones are moving into a leading position. Which ones may have been lagging but are now getting better. How do I prepare for those? At what point do I say, that's improving? It's still a lagger, but it's improving enough for me to believe that I should commit some capital. And the scale is a little skewed here because of XLE, which is the energy ETF. I don't think I need to explain that very much. But that also is starting to turn, not into strengthening, but it's starting to turn into not getting worse anymore. And that's what these charts are really all about, these relative rotation graphs, is looking to see not just what's stronger or weaker today, but how are they playing out against each other over recent history. This is in many platforms now. I mentioned Bloomberg terminals have them, Optuma has them, perhaps others do as well. And it is in our curriculum as well as understanding relative relative rotation graphs, which are a next generation of relative strength. As I said, we go back to our history. We still use that material, but we also carry it forward.
Stan, I just want to make one comment. I think that's a great illustration, sort of busting that myth that technical analysis is only for short-term, intraday, single stock traders. And when I first joined the association, I got to meet a lot of financial advisors and equity strategists that were delivering on behalf of clients and for those in the advisory community, running portfolios that are simply tilting in and out of sectors. So they're doing tactical asset allocation work, not watching the screens all day and day trading clients' accounts. And I think for me, seeing technical analysis used in that way as an asset allocation tool and specifically for equity strategists, just looking for a little relative outperformance on a sector bet, that really drove that point home to me, that technical analysis could be used over any time frame for any style of investor.
Yeah, I'm very agnostic as to time frames. I've done a lot of intraday work. I was a member of Floor Trader for a couple of years. I've done work on, I think the smallest interval, and I've done a lot of day trading work on is 3-minute bars. I also use longer term bars for other work that I do. In terms of relative strength, this is a raw relative strength. I've done work with averaging that, so smoothing that, and using two averages of relative strength, so that you see a more cyclical rotation in relative strength over some time frames. You're absolutely correct. Don't be misled by those who would about technical analysis applied to any time frame. It's valid on any time frame in which you have data and liquidity.
Well said.
That's my contention. And as I said, I still look at short-term bars, short-term meaning sub-daily. And I also look at weekly and monthly bars when it's appropriate for certain other things that I do. Of course, anything I talk about doing is for my own money. I don't work for a money management firm or brokerage firm any longer. So anything I do is just for my own capital or research. But I span the range. They're applicable. There are sometimes you'll adjust tools and use them differently depending on your data set and your time interval, but it doesn't invalidate them. I know there are some questions that popped up in there, and I'll try and pick this up so we can get to those questions, or I don't know if they were answered or not. But I just want the people to know that we do see there are questions coming in, so let me try and stay on target here. Two other concepts I'll mention. One is the concept of breadth. I'll get this rolling here a bit. Breadth is really simple. Breadth is the idea of we look at stock indexes. We looked at the S&P. We look at the industrial average or any other stock indexes or ETFs, and we make a judgment based. We interpret it as a single item being traded. We interpret we do technical analysis on the industrial average or the S&P. But the S&P 500 has 500 stocks in it. So what is the influence of the 500 stocks? How many of the 500 are participating in a trend? If I identify an uptrend or a downtrend, how many of those stocks are participating? If there's broad participation, a net increase in the index while more issues are declining would be worrisome. So breadth is an analysis of how many issues are participating. It could be market-wise. It could be U.S. Most people will do it on broad indexes such as the S&P 500 or even the Russell, some of the Russell indexes. There's an old expression about, is it a stock market? In other words, am I trading the S&P, which you can do via options and futures and ETFs? Or is it a market of stocks? And sometimes we lose sight of the fact that the S&P or any other index is just a number composed of the underlying stocks. So breadth is really pretty simple. How many of the stocks are participating? There's a traditional advanced decline line for the S&P. It's a weekly chart that you see on top, and it's the advanced decline line weekly. You can see as we had the rally following the December 2018 low, we had a nice rally all the way through to the highs in February, and we had great participation. more and stocks advancing than declining. Great participation. Where did it get a little tough? Right near the top. This is hindsight. It's not a perfect signal. Technicians use tools together to get quick signals, to get confirmation, to interpret according to the rules that they put together. So I don't want you to say that, well, it was obvious. I'm not trying to say that. What I am saying is that there were signs. And depending on how you managed the funds or advised your clients, you might have included this. This was the peak. These arrows do line up. I did that when I made the graphic. So here was the peak in breadth at this point in the market. By the time the market was peaking, this is roughly mid-February, here's where we were in breadth. There was less and less participation, and certainly it began to fall off. We know that breadth fell off when we had this big break. Okay, it was a warning sign. Gee, the index is still going higher. There's got to be enough action, enough stocks to carry the index higher, but fewer and fewer stocks are participating. It's not punching through. This sets up the next topic, which was the price. The breadth made a high here. Price made another high, but breadth did not. Non-confirmation or divergence, which was exactly a perfect setup for the next idea. So divergence analysis, I talked about indicators enough already, separating signal from noise. I talked about the idea that an indicator is supposed to help me confirm price action. If it doesn't help me do that, it's not good for me. I shouldn't use it. Maybe someone else can use the same one, but maybe it doesn't fit the analysis that I'm doing. So does it help me identify signal from noise? Does it help me cut things away, cut away the noise? And does it help me identify important points? That's why we use indicators. But then the indicator should confirm the price action. If a price is making new high, and I'm focused on indexes here, but this could apply in many ways to an individual stock, to a futures market, to a currency. If the stock makes a new high, is the indicator confirming the price action? What is the indicator telling me? Is it giving me useful information that's hidden in the noise of price? So here's an example. Here's the S&P weekly again. Here's that same period where we were looking at breadth earlier, where we had a high followed by the ultimate high that we had in February. Now here's a different breadth tool. It's covered in our material. It's commonly used. It's the number of stocks above their 200-day moving average. That tells me something about breadth. How many stocks are showing good moving average strength or strength relative to their moving average? So you see that peaked before price. And by the time price peaked, this was diverging. Wow, I have a new high in price. Is it confirmed by my indicator? No, it's not. It's not a final signal all the time, but it's weight of the evidence. It's one of the things you might look at and say, there's a problem here. I've got to be cautious at the least. So this is another version of breadth and a divergence. Here's a momentum oscillator. It happens to be the relative strength index. If you're familiar with it, great. It's not relative strength. It's RSI. It's a relative strength index. If you're familiar with it, fine. If not, it's a momentum oscillator for this purpose. Notice what happened. When did it peak? The same point. And then the next high was lower. Gee, I've got a new high in price. It's not confirmed by my indicator. It's not confirmed by breadth. I've got to give this some thought. I've got to take a look at my other analysis. Is it time to protect myself more, or certainly not to add? How does it fit into my other technical analysis work? So those are the three things that I wanted to provide you with. I wanted to give you some things to think about: relative strength, breadth, divergence analysis. All of this is in our curriculum, but this is what technical analysts do. This is what we do. This is how we look at markets. We try and organize a set of tools that lets us see signal from noise and look for weight of the evidence. Always look for weight of the evidence and do it in a framework of managing risk, identifying the direction, how do I participate, and manage the risk. I hope you'll consider joining the program if you're not already, and I'm confident you'll get quite a bit out of it. My colleagues and I work hard on the staff and the volunteers who put a lot into the CMT program.
Thank you so much, Stan. I think that was a great overview of those tools for folks who are seeking to improve their investment results, right? Their investment discipline. We did have some questions from the audience, and this gets at that art versus science, right? The tools are very scientific. The way that you apply them in what combination on what markets, that's up to each person. There's some art to that. But the question we had first came from our audience, just asking about there are a number of formulas in level 2. And if you could address sort of the expectation for candidates with respect to those, is it interpretation or how changes in the variables affect the output?
That was well said the way you just put it, Tyler. We do expect that you understand the critical inputs in the formulas. Here's what I mean. You should understand that what goes into, let's say, how would I compare them? Well, 2 that I use as an example, and I don't remember exactly how we phrase it in the text, but RSI versus stochastic. 2 different oscillators used for overbought, oversold, or momentum, okay? Well, RSI uses closing prices and the change in closing prices. And stochastic uses the price ranges of the bars. So they have different input. They look very similar. They can be used in a similar fashion, different signaling rules somewhat, but they're very analogous. But they have different inputs. One uses closing prices and the net change from close to close. The other uses ranges. What's the relationship of stochastics to Williams percent R? Well, it's quite similar. It tends to be reversed in its appearance. Graphically, it's reversed, but it tends to be very much the same because Williams does work on the location in a range. He does the location of price within a range of prices, which is similar to stochastics. It's not the same formula. So what I just described are 3 things. What were the inputs? Well, closing prices for RSI and ranges for stochastics and percent R. Those are things you definitely should know. We will not give you a raw set of numbers and ask you to calculate the RSI or calculate the stochastic. We will not ask you to write down the formula and repeat it back in mathematical notation. The other thing that's important is take a look at the beginning of the chapters for the learning objective statements. And we emphasize certain things in there. There may be questions that stray a little beyond the exact learning objectives in the front of each chapter. We go through them, the questions on the exams, to make sure that they are legit and they feed off that, but there may be a variation. It may be something like understand the difference. The learning objective statement may be understanding the difference between RSI, stochastics, and other momentum oscillators. Well, so we may ask you about percent R or a raw momentum oscillator. But understanding the difference is not writing the formula. It's focused on those inputs, focused on the application and the inputs.
And we've got the link directly to the level 1 learning outcome statements right there in the chat. But you'll find all of that information at cmtassociation.org if you want to go through the learning outcome statements even before you pick up your copy of the textbook. We have one other question here, Stanley. Besides the official curriculum, online questions, videos, and past exams, what else is needed to ensure a successful result on the exam? And I think this is a good broad question for everyone considering the program. And one thing that I'll mention, I'll let you give your own answer, Stan, is there is a range of recommended hours that we put in for those who are approaching the exam. And we know that we've got candidates who have 20 years in the business. Stanley Dash himself came into the CMT program after a very provocative and diverse career throughout the industry, covering many different asset classes, lots of different roles, a true expert, and it still took time to study. So I think the first thing that I would tell everybody is that you might learn some technical analysis just from the analytics platform that you have at your firm. You might have learned on the job from others. There is an official textbook and an official answer for the exam, which may vary from the way that you learned it, on the floor of the exchange. So I think in order to be successful, you need to approach the exam not relying too heavily on prior knowledge, but really approach the exam as you're studying the new material, the way that it is presented in the curriculum. And Stan, I'll let you add your own piece to that.
Yeah, absolutely. The curriculum is, I like to say, it's printed and distributed by Wiley, but the association is responsible for the content. There are other tools available from other providers, including Wiley, that we don't get involved with. Wiley is reputable. Optuma is very reputable, but we don't get involved in the content. So I'm just going to stay hands off. That's the appropriate thing for me to do since I'm on the credentialing side of that equation. So we don't publish sample exams, meaning the association does not publish sample exams. We don't publish any additional study guides. We have certainly our educational videos that are available to our members and some to the general public. As far as I'm concerned, if you study the text, that's enough. Now, that doesn't mean that you shouldn't expand your knowledge. That doesn't mean that you don't read a couple of chapters that are drawn from a book by Aronson or Kaufman or Kirkpatrick and Dahlquist or anyone else's or Steve Nissen and decide that, you know what, I'm going to get the book because those 3 chapters were really good and I'm really interested in it. And even though there may not be questions from other parts of that book, I'm going to grab that book. Mm-hmm. We encourage you to do that. We encourage you. You may open a magazine or see something online. You say, wow, that's by an author whose chapters I just read. So now reading an article in Stocks and Commodities magazine from Perry Kaufman is going to look a little different to you. You're going to be interested in it. But the text is the source for the exams. The learning objective statements, which as Tyler mentioned are in the text, of course, but are also available as PDFs on our site. The learning objective statements are critical to knowing what information you should draw from each chapter.
Excellent. Well, I know we are now at 9 o'clock. Last couple of questions here from the audience. They're asking about changes to the curriculum and textbooks in 2021. You might want to mention just the move to editions, and that we'll see another edition at some point in 2021.
In what content changes will be made? Well, okay, we have exams coming in December of this year, 2020. Same texts that are available right now. So the question really relates to what text would someone use if they're studying for exams for June 2021. I don't know exactly what content changes will be ready for that yet. There's a lot of material in the works. If some things may be ready to go, some things may not. I am very conscious of making sure that the texts are not only up to date as possible, well written as possible, but that the exams match what is in our texts. So if we have a change in the way something is presented, we might have to modify some of the questions just so we're not trying to trick you up on wording. We're not trying to trick you up on a definition that is used a little differently by one author than another. So we will make an announcement by the end of the year, if not sooner, on what we expect from for the textbooks, the next go round. I can't give you a pat answer on that now. If you're studying for December, use the current books. If you're using some of our books now and thinking forward for June of 2021, you'll be in good shape, but I can't guarantee there won't be some changes. It will not be discard the book and start over. Mm-hmm. That will not happen. Mm-hmm. But there may be some changes and some things you'll have to accommodate. But if you're reading the current level 1 for 2020, in the main, you're going to get it because in the main, that's still technical analysis.
Excellent. Thank you, Stan.
Sure.
Well, I think at this point, we need to let folks get back to the markets that are going to open here in a half an hour. And I want to thank everybody for joining us today. I know there are professionals all around the world looking to improve their investment discipline and open those doors for career opportunities. Stanley, thank you so much for your time to share with us. And thanks to those who've joined us this morning. We look forward to any questions that you have. You can reach out to Stanley or myself. Very simple email addresses, stan@cmtassociation.org or tyler@cmtassociation.org. And all of our colleagues would be happy to help you with any questions you've got as you're going through your course of study. We should also mention that candidates and members themselves are a great resource. So for those of you who know other charter holders in your city, you can reach out to them. We also have an online discussion board that works globally across all candidates, where there's a very active discussion as people are preparing the material. So we look forward to having you join us. Thanks so much for listening this morning, and we'll see you again real soon.
Thanks, everyone. Be safe.
Take care.